Welcome to the Coldstream Investment Strategies Group quarterly webcast, summarizing the first quarter of 2017. My name is Howard Coleman. I am the Chief Investment Officer at Coldstream. And with me today is David Powers, the Portfolio Manager for Roger Reynolds' team. David will be providing a market recap, and I will be presenting our special topic, which for the call today is cross-currents, navigating through conflicting data. For this call, there is a box on your screen where you can type in any questions that you might have. We will try to address all of your questions today, but if we do not get to all of them, please contact your RM, your relationship manager, or your portfolio manager with your question. While we have scheduled this call for 30 minutes, please bear with us if we run over by 10 or 15 minutes so that we can cover these topics thoroughly for you. I apologize in advance if we are not able to get to your call, but again, please contact your relationship or portfolio manager with the questions you have. I will now turn the call over to David for the market update.
So I'm going to jump right ahead, actually get to the conclusion here and just show the index returns for the first quarter and a little bit into the second quarter. As you can see, it was a pretty impressive start to the year. A lot of crooked numbers in the positive direction, building on a strong fourth quarter, and more importantly, or more specifically since the election, you can see large cap has actually accelerated their returns from since the election, up 6 for the S&P 500, 10 for the NASDAQ, and 5 for the Dow Jones Industrials, which represents the large caps. The smaller cap stocks continue to move forward, certainly not at the pace that they did in the fourth quarter, but still pretty strong. The more impressive equity asset classes fell in on the international side with EAFE and emerging markets. EAFE up 7.25, emerging markets continuing or following through on their strong 2016, actually beating the entire year there in the first quarter. On the fixed income side, you did a little bit better than coupon, which is pretty good when you consider the first quarter of the year and where interest rates are. The commodities, it was really the only negative asset class that you saw there not following through on its 2016, at least on a year-to-date basis. And hedge funds and real estate have been pretty steady, given their lower correlation to what's gone on in the equity markets. Moving on to some specific asset classes, when we take a look at what goes on, there's really 3 things we try to pay close attention to. Obviously, the economy is one of them, and Howard's going to go into that in much more detail. But we also take a look at momentum and valuation in these various asset classes, specifically in the equity market. And really, what I'm showing you here, this chart sponsored by Bloomberg, basically showing the S&P 500, which is your large cap stocks. And from a momentum standpoint, this is probably one of the more attractive charts that you'd want to see. Obviously, if you go back to 2014 and 15, we slogged along, basically just getting your dividend payments and nothing on price appreciation. But after a very difficult January in 2016, you could see that, and I've kind of crudely pasted on some arrows here so you can follow along, but you can see certainly the beginning part of 2016 after the initial dip was strong, then we consolidated, then we got another strong move at the end of the year post-election. And here we again, in basically the last month or so, have kind of gone back into that consolidation period. That's a good sign. And we do think that going forward that the S&P can continue to move forward, the next leg can be forward, but certainly we're going to need to see some things in the second half, some promises coming through on the campaign trail that actually get to the bottom lines of income statements. But for now, we certainly feel very comfortable with the direction of the S&P 500 and how it's reacted here to start the year. Certainly one thing I'm always paying close attention to and get the rest of the group trying to get them excited about is valuations, and just kind of see where we are. Again, this is taking a look at the S&P 500. We've got 2 things on the scale here. The red line depicts price to earnings. The blue line depicts price to sales. Again, I've crudely pasted basically a range line here right over that 20 mark. So you can see closely that we don't, certainly we've spent some time over that 20 PE ratio here in the 90s and beyond, but you can see it's a relatively new phenomenon. This is something that generally did not exist. This chart goes back to 1955. You can see the average PE is about 16.5. So certainly we're not in nosebleed territories when it comes to PE valuations. As you can see, kind of looking at 2000, 2002, everyone probably remembers the technology bubble there. But again, we generally don't spend a lot of time above these 20 marks, and so that's something we're paying close attention to as we continue to climb. Hopefully, we can get earnings that are a little bit stronger. I got a chart on that next that points to some stronger earnings. But for now, we are a little bit concerned about the valuations and where they stand, and we're certainly trying to match that up with what we're seeing from a momentum standpoint. The other on this chart is price of sales, which is actually reaching those nosebleed territories. We look at price of sales because it's an unencumbered number, right? It's your top line, and basically doesn't get affected by your add backs when you take a look at operating earnings and stuff along those lines. So it's a pure number. It actually has some pretty good correlations with future returns. And so you can see here that we are getting up to the areas of the technology bubble. So while the momentum in the market has been terrific, specifically for large caps, we are cautious on where the valuations stand. It's right, we generally don't back up the truck in any one asset class at this particular point. I mentioned the earnings aspect of things. You can see, you look at the bottom of this chart, basically this shows year-over-year growth with the blue column lines, which is what I want to focus on here. And you can see that basically all of end of 2014 and 2015 and into 16, not a lot of earnings growth there on a year-over-year basis. That stopped basically at the back end of last year, and now it looks like we're going to re-accelerate here, certainly into the first quarter, expecting about 10% returns, and earnings have come in pretty good so far. And that's supposed to be on average basically through June and September before we re-accelerate again back in December. Point being is you kind of take a look at the earnings side of things. If we can get better earnings numbers, those valuations start to look better. So if we can keep roughly the same multiple, or don't have any multiple contraction, and get these kind of earnings growth, you can actually end the year with pretty good numbers. And obviously we're off to a pretty good start based on that first chart that I showed you. Switching, I actually want to focus on one more thing here on the large cap side before we move over to small cap. Basically, I want to show the convergence between growth and value here. After the election, which this chart basically starts on, the blue line is VUG, Vanguard Growth, which is the blue line, and then the orange line is value. You can see right after the election, value had a very, very strong run. Tech or growth or technology struggled a little bit. Obviously, remember Trump coming out and saying that companies of the nature of Apple, Facebook, and Amazon were going to struggle. He was going to put the hammer down on them, and obviously the market reacted. Value did much better, but that has changed certainly since we started this year. You definitely see a bigger move towards growth, and now growth is actually, since the election, outpaced. Both have done extremely well. Let's not forget that, but certainly growth has done a better job here. So if you've got a little bit more of a value tilt in your portfolio, underperforming slightly here in the beginning part of the year, certainly it's just been what's going on in the market. Switching over to the small cap side, as I promised, again, chart sponsored by Bloomberg here. You can see a little bit different than what we've got, in the large cap side. Both momentums we would consider very strong. Obviously, small cap since that 2016 have basically gone straight up. But you can see to start the year, we've definitely been in a longer consolidation phase. The last couple of days notwithstanding, which has been very attractive for the small cap stocks. But basically, this has been a sideways run for them to start the year. But obviously, given what we saw in 2016, this can certainly be understandable about where this benchmark sits in the beginning of 2017. You kind of switch to the valuation side of things, though. It's roughly the same story as we've seen in the large cap. Actually, maybe even to a greater extent on a PE basis, which again is this red line, is basically at all-time highs. Unfortunately, this chart only goes back, we can only have the data back to the 90s here, but still very robust price to earnings ratio, and also the same thing on the price to sales. So it's not a surprise that you come out of an election where things are based on the campaign promises are likely to benefit small cap companies. We got that big move up. That makes perfect sense. But the fact that we haven't seen a ton in terms of where, in terms of the campaign promises, certainly on the pro-business side, you can definitely understand why we've got more of a longer consolidation phase in the small cap area. On the international side, again, really attractive. There's not a lot of, usually I end up doing this presentation in the middle of July, which is usually after things kind of slow down in the summer and we get a little bit of rollover. I got to come in with a negative tone, but I don't have that. That's not going to happen this time around. Everything here looks pretty good from an equity standpoint. Certainly here on international, certainly has been beat up over the years in terms of why do we need it, but obviously it's been a very strong move on the international front, basically, kind of all the way going back to the dip that we saw back in January of last year, and obviously with the French elections going the right way, or at least the beginning of that process going the right way over the weekend, you can see that big leg up just there at the end of the chart. And if we added in yesterday's, you would have gotten a little bit higher up. So certainly good move on the international side. This is a chart we've shown you before, and it's going to take a little bit of explaining, but basically it pits the U.S. versus international. The rising line would indicate that U.S. is outperforming. A declining line would mean that international is outperforming. You can see, obviously, since March of 2008, which is the crisis, it has been a very, very good stretch for U.S. stocks. The solid black line represents your average, basically going back to 70, so we're looking 1970. So we're looking at close to a 45-year window here, a little bit north of that. You can see that the dotted lines are your 1 standard deviation, and the solid red line is a 2 standard deviation. And if any of you are familiar with statistics, 95% of your observations should fall within those 2 solid red lines, and now for the first time really in 45 years we're actually outside of that. So that's a rare from a statistical standpoint. Obviously there's some fundamentals on the international side that give us pause, and it's the reason why we again haven't been huge overweighters in this area to portfolios. But obviously given where we are from a relative value standpoint, you can see the attractiveness here, and if the first quarter is any indication, we might be seeing the turn of that. It's something again we'll pay very close attention to. Again, the last asset class on the equity side paying attention is emerging markets. A little consolidation here at the end, but obviously a very strong run that we've seen basically again since the beginning of, since the dip that we saw back in January. So obviously you see that theme approaching, but even coming out of this, out of the election, we have a little bit of a dip there. But since the beginning of the year, remember the 11% I showed you at the beginning of the year, beginning of this presentation, obviously we're off to a very good start in emerging market land. Part of the reason why both have done very well is you take a look at the trade-weighted dollar. The dollar has traded off here a little bit, and that obviously helps your foreign investments. But I will caution here, even though this trend looks like it's pretty strong in the favor of foreign currencies, you can see if you can just slide over to the left of the chart and kind of line up where we were at this time last year, you can see that was basically the same case. So the trend has certainly been in favor as we go back to 2015 here for the strength of the U.S. dollar. But certainly right now we're in a little bit of a period where that hasn't been the case, but we're not ready to give up on the dollar strength just yet. But certainly the trend is down, but that is obviously very positive for your foreign investments. Switching gears to get into fixed income, obviously a different story here after the election, and we've got the Trump tantrum, which was I believe coined by my colleague Darren Ritchie. You can see that the bump up here, obviously, whatever was good for stocks was not good for bonds. After the election, but importantly here we've gotten a little bit more of a consolidation phase. Looks like we've got a trading range here between the 2.2 and the 2.6. So definitely interest rates have started to behave, even though that the front end of the curve has started to move up a little bit. So we're comfortable where interest rates stand. We think this trading range can be something that's certainly moving forward, can be maintained, and as a result, we can continue to get positive returns in the fixed income market. Just quickly taking a look at the yield curve, this goes back, the dotted line is back to 13, so you can kind of see from a historical perspective where we were. But taking a look at now where we are in 2017, we've definitely seen a much flatter curve. We would anticipate that front end coming up, but based on the chart that we just saw and interest rates kind of behaving there, we don't expect too much on the back end of the curve, which we think can be okay if you've got a little bit more duration in the portfolio. Taking a look at munis, basically from the start of, kind of take a look at where they were at the election. You can see there was actually very good value in the munis. The munis is the white, treasuries are the red lines, and obviously, given their tax-favored investment, you would expect to be trading at a little bit of a discount to, or a little bit of premium, I should say, to the treasury. That wasn't the case at the election. Everything looked like they were on even par at the early part of the, on the front end of the curve, and a lot of value on the back end of the curve. That shifted a little bit. You can still get some value at the back end of the curve, but on the front end of the curve, that's just not the case. So, obviously having a little bit more duration in the portfolio gives you a little bit more value. Just to talk a little bit about munis, Nina showed you this at the beginning, at the kind of the beginning of the year chart. And obviously last year, not a great year for munis. You can see 0.25. There's been other years where things haven't been particularly rosy in muni land, going back to 2008, 2013. Even 2010 wasn't particularly strong, but you can see in the following years, basically as interest rates rise, you're able to reinvest at higher rates, which means you can get some strong returns in the portfolios, and that's what you got in 2009, again 2011 and 2014. Quickly on high yield spreads, we're below average. The trend continues to move down in this particular, and that's been the case. We can stay below these lines for a long periods of time. That's certainly been proven, but obviously there's less value in the high yield market than there was certainly going into the beginning of 2016. And just a couple things before I turn it over to Howard. Just, I think the question we always get, maybe preempted, to say, what are the things that keep us up at night? These are the things we pay close attention to, maybe outside of the beaten asset classes that you take a look at, the beaten path asset classes. And you can see housing here. What I have here on the left-hand side is existing home sales, which basically continue to rise. Housing market is doing particularly well. But in the red line, we have 30-year mortgages, and that's to an inverse. And so obviously, as the red line moves down here, that means rates are getting higher. That should impede home sales, and that hasn't happened yet. We continue to see strong home sales, so it's something we're paying close attention to. The last time this happened, mortgage rates actually came back down, which was, obviously helped sales, but obviously the prevailing thing is interest rates have to rise. We would expect home sales to come down, so that's something we're paying close attention to. The chart on the right basically looks at sales a year ago, and obviously every incremental move up in mortgage rates has an effect on somebody, and you can see obviously in the lower trading homes or the lower priced homes, you can see that the one-year changes haven't been particularly strong, even negative on certainly the much smaller homes, but it has not affected the larger sales. 500 to 750K over 1+ millions have done extremely well. So obviously at some point, if interest rates continue to rise or mortgage rates continue to rise, at some point that's going to leak its way to the other side of the chart and affect home prices, which obviously have an effect on the economy. And then taking a look quickly at oil, just want to look at the back end of these charts really. The oil rig count, which is the blue line on the left, came down significantly as oil prices came, and that was obviously beneficial for oil prices, and you can see that on the corresponding chart. Oil obviously going from 30 back up into the mid-50s, but as production has started to come back online, it's not a secret that now oil prices are starting to come down. In the right-hand chart, I've got oil in the red line, and then we've got XLE, which is a basket of basket of energy stocks. So all those have started to trend down. Everyone makes reasons why this is happening, but I don't think it's a surprise. We don't think it's a surprise that if you take a look at where rig count is and production starting to come up, that this is kind of the result of that. So obviously, if more production is going to come on, or they're going to restart oil rig counts, we would anticipate that oil could still be under pressure. And obviously, when it went back down, that was a concern for the overall economy. And energy is a big sector of what goes on in the S&P. And the last chart I'll show again before turning over to Howard is just want to remind everybody the power of diversification. We run diversified portfolios here at Coldstream, and we believe this is the best way to kind of achieve the goals of all of our clients. And you can take a look here. Basically, it's a range of stocks, bond, and blended total returns, starting with the one-year number. Obviously, just in equities, you can have some massive moves, up 47 being your best year, minus 39 being your worst. And bonds, getting -8 to 43, and obviously a blended portfolio is going to be somewhere in between on that in any given year. -15 is a lot better than -39, so obviously having a blended portfolio on a 1 year can certainly save you some pain. But even going out on a 5-year rolling, 10-year, and 20-year rolling, you can see that there's no negative periods for a 50-50 type portfolio. And more importantly, even if you were just a total stock investor or a total bond investor, if you're disciplined with your approach and have a plan, you can make money obviously over a longer period of time. So I know we focus a lot in our meetings on 1 year or shorter numbers, but if we really break it down to what goes on over 5, 10, and 20-year periods of time, you can see the power of diversification, but more importantly, the power of sticking to your plan, sticking to your discipline, and sticking to what you and your relationship manager and PM have certainly agreed to. And with that, I'll move it back over to Howard to take the laboring oar of this presentation and focus on what's going on in the economy.
Thank you, David. Our special topic today is cross-currents, navigating through conflicting data. It's not unusual to have conflicting data indicating signals that could be different and make markets or economic indications vary. However, we're seeing conflicting data here today that's more than usual, pointing in different directions. And I just wanted to walk through some of that with you and talk to you about our thoughts in terms of dealing with that. First is consumer confidence, and let's start with the consumer because the consumer is a large part of the makeup of U.S. GDP. This is the Conference Board Consumer Confidence Survey conducted by the Richmond Fed. And as you can see, consumer confidence through this survey is very, very high. This is what economists call soft data. And the soft data is generally very good. And when we're talking about the diversity between conflicting signals, it really focuses on the hard data versus the soft data. And here we see the kind of indications that we're seeing in the soft data. Generally, it's a survey of what the consumers think about the economy, and it's very, very bullish. Let's contrast that, however, with what retail sales look like, which is obviously the expression of what the consumer is doing right now. And we can see that despite the strength in consumer confidence, the actual retail sales have not been good this year. Similarly, manufacturing, and this is a survey again by the Richmond Fed regarding manufacturing sentiment, and sentiment among those involved in the manufacturing industry is really good right now. It's been soaring since the election. Same with similarly to consumer confidence. However, if we look at actual industrial production, it's fallen since February. So again, we see a conflict between what the hard data, the industrial production, is saying, and the soft data, the survey of manufacture. This conflicting data not only extends to the economy, but does extend to markets. And this follows on what David was saying, in that there really is a divergence between what the U.S. stock market and the bond market are telling us currently. The stock market has been relatively strong this year, as David has shown us. But in the bond market, yields have come down. They now are back in a trading range, but yields are down. And usually when people were expecting a strong economy, high inflation, strong growth, that's a sign that interest rates are going to rise. And here we haven't seen that significant that significant increase in interest rates, while at the same time we've seen bullishness on U.S. earnings and growth. So again, we're seeing a divergence between the bond market and the stock market and what they're telling us. Gold has also been a very strong performer this year. And gold is also oftentimes a source of what people invest in when they're scared, when they're fearful. But at the same time, as I pointed out, and as David pointed out, this is going on at the same time that the stock market has been rallying strong. Now, gold has come down since the French election, and part of the concern, I think, had to do with the French election. But nonetheless, it still is rallying very strongly, while at the same time the stock market has. Turning to Europe, we have significant issues with Brexit. The negotiations are starting. There's great uncertainty in how that will resolve itself. But the FTSE, this is the average of the British stock market, the equivalent of the Dow. This is the FTSE year over year, and it's just gone straight up, just like the U.S. has. Brexit concerns, not in the stock market, not reflected in the market. Similarly, bunds remain low. Now, bunds are 10-year German treasuries, and in these calls last year, we talked about how over the 10-year treasury was in negative territory and how that was really just unprecedented, the fact that you would be paid, you would have to pay to own German treasuries. Now, it's no longer negative, but it's still very low. It's still less than 40 basis points. And we have significant concerns. Even though we have the French election that seemed to turn out well, there's still a significant uncertainty in Europe, but it really is not being reflected in the bond markets. And in the U.S., we've had an amazing period this year of low volatility. From the beginning of the year until March 22nd, we had 64 straight trading days without a 1% intraday move. Unprecedented. Here's a chart going back to 1962. Nothing else has been close. And at the same time we've had that low volatility, we've had enormous political uncertainty, geopolitical uncertainty, and economic uncertainty. So it's been a real contrast between the calmness of the market and the uncertainty that we're looking at around the world in geopolitical events. and the uncertainty of how strongly the economy is actually recovering. Now, corporate profits are a good sign. Corporate profits have been very, well, dismal's too strong, but they have not been good over the last year or so. And as David pointed out, they are picking up. Now, this chart is a little bit busy, but the red line shows foreign corporate profits. The dark blue line shows corporate profits generally, and the light blue line shows domestic U.S. corporate profits. All of them are indeed improving year after year. However, they are improving from relatively low levels. But nonetheless, even though corporate profits have been rising, corporate loan growth has stalled. And usually when corporations are confident, they're borrowing and they're increasing their leverage, which of course is a mixed bag, but it often is a sign of confidence. And here, despite the increase in corporate profits and the positive sentiment, loan growth has stalled. This is a summary chart. It's a Morgan Stanley summary chart of surveys and business cycle indicators, which is soft data, and the average of other hard data components. And this really starkly shows the divergence between sentiment and data. The yellow line being the soft data, obviously, and the blue line being the hard data. And this has resulted in something that we have seen a divergence before, but not to this extent. The New York Fed puts out a nowcast, which is a projection of GDP, and it focuses on both survey data and hard data, but has probably a little stronger lean toward the soft data. And the New York Fed's projection for first quarter GDP in the green line currently is at 2.83%, and this moves over the course of the quarter, as you can see, as additional data comes in. Now, the Atlanta Fed, the GDP Now forecast, which has historically been the most accurate of the forecasts, really just focuses on hard data. And that forecast shows a GDP projection for the first quarter of 91 basis points, 0.91%. It's a significant divergence, and that divergence, again, is due to the New York Fed's inclusion of a lot of soft data in their forecasts. Bottom line, however, is that we don't have a recession ahead. These are the Conference Board leading economic indicators. They have been favorable since 2014. They continue to be favorable. We don't see a recession in sight. But we do see these conflicting signals. And with the conflicting signals and with no recession in sight, really our thinking is to stay the course. We're maintaining a relatively neutral stance to both the stock and bond market. We, as David indicated, momentum and valuation are also showing us different things, but momentum can remain for a long time and valuations can be rich for a long time. We're not pulling on our horns, but we are not being overly aggressive because of these conflicting signals. We are maintaining a relatively neutral stance. So that concludes our call for the first quarter. Thank you for listening. If you have any further questions, please talk to your relationship manager or portfolio manager, and we'll see you next quarter. Thank you very much.